All right, let's get right into this fundamental equity profile of Newmark Group. As analysts, we're looking strictly at the cold, hard data today. Recent financial disclosures, earnings transcripts, and forward market forecasts. Now, if you track commercial real estate at all, you know the sector has been hit with some pretty severe macro headwinds lately, right? But Newmark is presenting a truly fascinating case study. Today, we're going to unpack exactly what is driving their intrinsic value and why Wall Street is suddenly paying very, very close attention. So, sitting right around $13.98 a share, with a $2.79 billion market cap, Newmark is flashing some highly compelling fundamental signals for both value and growth investors alike. When you contextualize this valuation against their actual boots-on-the-ground operating performance, a really distinct narrative starts to emerge. We're looking at a business potentially trading at a very steep discount to its true earning power. I want you to really listen to this quote, highlighted by CFO Mike Rispoli during their Q1 call. 10 consecutive quarters of double-digit revenue and volume growth. Think about that for a second. That is the anchor for our entire valuation analysis today. Pulling that off in this kind of macro environment, it tells us Newmark isn't just floating on a cyclical wave, they are aggressively outmaneuvering competitors and capturing real market share. Here's a quick look at the roadmap for today's explainer. The business model, record Q1 earnings, growth and expansion, balance sheet and dividends, institutional ownership, and analyst forecasts. Section 1. The Newmark business model. Understanding the revenue engines. Basically, Newmark executes across 3 diversified service lines. First, you've got capital markets. This is the big stuff, structuring massive, complex investment sales and debt. Second is leasing, representing both the tenants and the landlords. And third, management and servicing. Honestly, this last one is critical. They oversee a $211.2 billion servicing portfolio. Together, these engines mean Newmark is capturing fees across the entire commercial real estate lifecycle. For a fundamental analyst, that setup illustrates the ultimate prize, an economic moat. Newmark's moat relies heavily on those recurring revenues, totally anchored by that massive asset management portfolio we just talked about. It essentially acts like a toll road, generating steady, reliable cash flows that protect the bottom line, even if broader market transactions temporarily freeze up. Section 2. Record first quarter earnings. Breaking down Q1 2026. You have to take a look at these numbers because they are pretty staggering. The company just reported an all-time best for the first quarter. Total revenues hit $846.5 million. That's up over 27%. Adjusted EBITDA jumped nearly 36%, but check out the operational leverage here. Adjusted earnings per share absolutely exploded by 57.1%, jumping from 21 to 33 cents year over year. That marks their 8th consecutive quarter of double-digit earnings growth. Just incredible execution. Now, any rigorous analysis has to play devil's advocate and weigh this massive cash generation against the operational headwinds. The bullish thesis is definitely anchored by capital markets revenues surging 45.5% and free cash flow skyrocketing over 111% to $361.5 million. But conversely, we have to price in a 24.5% rise in operating expenses due to their global expansion efforts, alongside management's guidance that the adjusted earnings tax rate is going to tick up to between 13 and 15%. Moving on to Section 3, Growth and Expansion. Looking beyond the core. So, what is actually moving the needle here? Management highlighted a few key catalysts driving this top-line acceleration. Their international investments are already yielding results. They actually hit profitability a full year early in France, which is fantastic. They are also aggressively grabbing market share in the data center and infrastructure management space. Plus, their M&A strategy is clearly paying off. Cross-selling into large institutional portfolios has been exceptional, and it's all being supported by normalizing return-to-office trends in their core US and UK markets. Section 4. Balance sheet and dividends. Capital returns and liquidity. All right, as any seasoned fundamental analyst knows, cash flow is great, but the balance sheet is where the rubber meets the road. How are they deploying that cash? Well, they ended the quarter with $212.1 million in cash against $832 million in corporate debt, leaving them at exactly 1.0x net leverage. Backed by a newly upsized $900 million credit facility, this highly conservative leverage profile insulates them from macro shocks while giving them some serious dry powder to work with. With that liquidity safely secured, we are seeing a very disciplined 3-pronged capital allocation strategy. First, they're funding strategic M&A and top-tier talent acquisition. Second, they're returning capital directly to shareholders via buybacks, retiring 10.4 million shares for $151.1 million. And third, they just doubled their quarterly dividend to 6 cents per share. Guys, a doubled dividend? That is management screaming their absolute confidence in future cash flows.
Section 5. Institutional ownership. Who is holding the stock?
Let's look at who else is sitting at the table with us. Institutions hold a controlling 58.4% stake, which provides a really nice baseline of stability. Yet crucially, this is still well below the 80 to 90% saturation levels you typically see in megacaps. So what does that mean? It leaves plenty of runway for aggressive accumulation by new institutional buyers, which is a classic catalyst for multiple expansion down the line. And the trailing 12-month data shows this smart money is definitely making its move. 169 institutional buyers deployed nearly $397 million in capital, completely overwhelming the 104 sellers. When you see major players like Vanguard and Dimensional Fund Advisors aggressively building positions, it signals deep institutional conviction in Newmark's long-term trajectory.
Finally, Section 6. Analyst forecasts and valuation. Wall Street's forward look.
Following their massive Q1 beat, management actually went ahead and raised full-year 2026 guidance. Looking at Wall Street's forward models, consensus estimates project top-line revenue marching steadily upward, breaking the $4 billion barrier to hit $4.25 billion by 2027. That is sustained, multi-year compounding in a notoriously competitive sector.
But the bottom line is where things get truly wild. Earnings per share is projected to absolutely rocket. Wall Street expects EPS to nearly triple from 2025 levels, hitting $1.99 this year. This model points to massive margin expansion, largely driven by that recovering capital markets sector and management's frankly ruthless cost discipline. For us value investors, this right here is what we call a margin of safety. The consensus from 7 S&P Global analysts prices the stock at a steep discount to its intrinsic value. The average target of $19.58 implies a 40% upside from current levels. Even the most conservative, lowest target on the street implies a 32% upside, backed by a unanimous buy rating consensus across the board.
So let's wrap this up. With 10 consecutive quarters of double-digit growth, a massive servicing moat protecting cash flow, and undeniable institutional accumulation, the fundamental profile is crystal clear. The only real question left is, does Newmark Group's deep fundamental value fit your personal risk profile and portfolio strategy? Well, that's a puzzle only you can solve. Thanks so much for joining me for this explainer, and as always, keep analyzing.